Good morning and welcome to First Mover, your first global look at today's action in Bitcoin, blockchain, and digital assets. I'm Jen Sanasi here with my co-host, the TIE Director of Content, Lawrence Lewitton. Good morning, Lawrence.
Good morning, Jen.
All right, some big stuff happening in the market, so let's get right into it. The CoinDesk Bitcoin price XBX index is currently at 31,114, breaking that $31,000 mark and celebrating some Ripple news that we're going to talk about in just a moment. And on that note, let's take a look at the XRP chart. Ripple's XRP token is surging for a second day after a U.S. judge ruled the sale of XRP tokens on exchanges did not constitute investment contracts. We have Ripple at 78 cents.
XRP. Yeah.
Thank you, Lawrence.
Magical coins that were found by Ripple.
Yes.
I think they were discovered by a leprechaun and given to the Ripple company, I think was what they say.
The last thing I need is for the Ripple army to come at me on Twitter.
Yes.
XRP is at 78 cents this morning. We're going to get into why in just a moment, but let's take a look at the Ether price, the CoinDesk Ether price. ETX index at 1,988, up almost 6%. Also celebrating the news we got around 12 p.m. yesterday. And DeFi assets, the DFX, CoinDesk's DeFi index is at 128, up 12%.
The State of Crypto is presented by Tron, connecting the world to the power of cryptocurrency.
All right, Ripple scored a partial win in its 3-year court battle with the SEC, bringing a little bit of regulatory clarity for the crypto sector. A judge ruled that the sale of XRP tokens on exchanges and through algorithms did not constitute as investment contracts. However, the institutional sale of the tokens did violate federal securities laws. Joining us now is our legal panel, Willkie, Farr, and Gallagher LLP counsel Michael Selig, along with Alex Damsker, a former SEC attorney who's now an advisor to INX. Welcome to the show, Michael and Alex.
Good to be here.
What got us to this partial judgment yesterday?
So generally speaking, Ripple had a few issues from the get-go, which honestly were issues that happened to quite a lot of companies that were started at the same time. They offered sales directly and to accredited investors, institutional investors, and to the public. And a number of the sales that were done to the public, some of them were done. My understanding of this was that it was done directly, but the ones that were addressed by the court were the ones that were done through exchanges, through crypto exchanges. And some of the XRP was offered to employees as compensation, and there were other methods that they were offered. And the SEC, in due time, has come through and said, okay, XRP, you've offered all of these tokens. We think that these are unregistered securities. We think that you've been trading unregistered securities. And that's a problem. And one of the things we don't talk about is one of the things that the SEC could do is something called rescission, which is essentially when you have an unregistered security, they could say that basically all the securities now are mixed together because they're fundamentally fungible. They should all be retracted and tossed aside. And that's basically like a reverse IPO. And most companies don't survive it. Instead, what the SEC has mostly been doing is saying, look, you have unregistered securities. We understand that you're currently operational for the ones that are operational. If you also did not do something else illegal, usually what they're doing is settling and there's a fine. And that's why this has been not actually the SEC trying to crush an industry. This is really trying to shut down unregistered securities. And then the concept has been if we let unregistered securities continue throughout our system, the problem will be that most people will just go ahead and offer unregistered securities, and there will be nothing to stop people from continuing to offer them, just saying later on, well, we did that, but now we're operational, so let it just slide. So where we are now is after settling. After many different settlement attempts that didn't work out, this has gone through court, and both sides put forth summary judgment offerings, saying the other side essentially had no argument. Even if all of the facts that were in the complaints were true and all of the responses were true, then they still did not meet their basic elements, and the court basically said for each side, sort of yes and sort of no. And there are still matters of fact at issue here, which means it will still go to trial.
Michael, talk to us about if this is a win or a lose for Ripple. It doesn't seem like a clear-cut win. It seems like there's still a lot to figure out here. And, reading all of the information that comes out, it's hard to determine whether this is actually good or introduces more complications.
Yeah, so the judge here makes an important distinction between the investment contract, the security, and the crypto asset itself, the subject of that security in certain contexts. And so, in the seminal 1946 Supreme Court opinion, the Howey case, there was this idea that you had an investment contract because orange groves were sold to investors together with this land management contract. And so the combination of these facts and circumstances create what's called an investment contract. But the orange groves themselves are not a security, and so they can be resold and sold in different manners. And those transactions themselves just involve the sale of orange groves. And similarly here, the court says, look, we're not going to agree with this broad SEC interpretation that the crypto asset somehow embodies that investment contract, such that when it's sold in every context, it's always a security. The security is the investment contract, and the investment contract analysis under the Howey test is a facts and circumstances based test. And so in every context, you're going to be looking at all the different circumstances and facts that surround that sale. And so when Ripple went out and sold crypto assets, XRP, to institutional investors and made certain promises and commitments and gave a contract to those investors and said, we're going to do certain things. You're going to lock up your tokens in certain contexts, not in every case. And there were other sorts of rights and promises made in that contract. These institutional investors had a belief that they were investing money in a common enterprise with Ripple and expected profits based on the efforts of the Ripple team. When Ripple and Garlinghouse and Larson went out and sold tokens blindly on certain exchanges, and those sales were only around 1% of all sales on the exchanges, customers or purchasers of those tokens had no expectation that Ripple would go out and engage in any certain efforts. They might have not even seen any of the marketing materials or promises or white papers and things given to institutional investors. The court here actually reasons that these retail investors very much likely were just purchasing these to speculate on the investment potential of an increase in price. They're not necessarily looking to any sort of efforts of the Ripple team, and they don't know who's selling them the tokens. They'd not agreed to lock up the tokens or any other sort of contractual commitments. And so in that context, the court very elegantly distinguishes between sales where purchasers are really buying a commodity, a good, and those sales where there's more promises and commitments made, there's more of an understanding that there's a common enterprise with Ripple. Persons are giving funds directly to Ripple and understand those funds are going to Ripple to build an enterprise, as opposed to sales where people are really just buying a good, and maybe they'll go up in price, maybe not. And so that's a really elegant way to thread the needle here and create a world where we have certain assets that are not securities, but in and of themselves, they can be deemed to be securities because, for example, they could be stock or they could be notes, or they, in theory, could be investment contracts if all the elements are satisfied. But they're not necessarily investment contracts simply because they were sold as investments.
Yeah, doesn't it by doing it this way, threading the needle this way, as you put it, doesn't that essentially open it up to this? one can argue, the SEC can argue, well, yes, the general public didn't know that it was being sold as a security potentially to institutions. And again, Ripple's saying that it wasn't a security when they sold to institutions, but that's aside. But if the judge is going to say that it was, then the demand for XRP by being observed by the general public, seeing it go up, it would have induced them to go out and speculate on the asset. And therefore, it might not have been a direct sale of a security, but an indirect, if you will, by creating that extra demand, if you will, for XRP and sort of pumping up the price. Wouldn't that be the SEC's counter argument ultimately? And so that this judgment, this ruling, isn't necessarily to Ripple's benefit in the long term until they can absolutely say no sales were securities.
So the efforts of Ripple have to be those essential managerial efforts that people are purchasing in reliance upon. And without any relationship with Ripple or understanding that Ripple's going to go engage in efforts to drive the price, these are really just widgets or goods sold into a decentralized market. And the purchasers of those might be looking to all number of factors to increase the price, just like the purchaser of gold or sugar or wheat is looking to a decentralized market. Just because OPEC can increase the price of oil doesn't mean that they're looking to OPEC when they buy oil. And in the same way, Ripple might be a factor, but there's no contractual obligations. There's no understanding that the funds are going directly to Ripple to increase the price.
Alex, it doesn't seem like you agree.
That's actually not how that works. So there isn't a requirement for an understanding that this is a security or the managerial efforts are to increase the market price. The efforts have to actually be to increase the value of the company. And there is an understanding that there's a project team. Everybody has known for a long time. It's been common knowledge. There's a project team behind Ripple that is doing something, right? Press releases are being issued to drive value into Ripple. And that is the thing that fundamentally will drive market price. That's how all securities work. So fundamentally, it's not about whether or not their money goes to Ripple. That's not the test of whether or not it's a security. There is a test about things being a security because you're using them for capital raising, which is one of the things that happened here. The issue of whether or not the public, like what the public relied on, most of that isn't even covered in this opinion, right? Which is one of the reasons why it's actually rife for appeal. But one of the things that they talk about is that, first, the concept that the investment has to be based on specific efforts to price just isn't how that happens. It really just has to be based on the efforts to grow the company. And I think there's been a constant understanding that here's the team, right? White papers are full of here's the team. Brad Garlinghouse and Larson have put themselves out as the people who are running this, and they're doing all this value. Here are the press releases. Look at what we're doing in order to increase the value of XRP. When you invest in it, you're investing with the hope of return. These are not people who are buying these tokens with the hope of using the tokens. That would be the distinction. Are you buying the tokens in order to transactionally use XRP? That's not what's happening. They're buying the tokens with the hope of selling them later for a greater value. That's the difference. So there's a few problems in this ruling that make it subject to appeal. I do think that, it's an interesting way to try and draw a distinction because clearly the judge is trying to make sure that the people who are current holders of XRP are not harmed by whatever is happening with their prior holdings. The problem is once you say that there's anyone that is holding a security, now you have this pool of securities that are mixed together with non-securities, and you can't tell which is which. And now we have a fundamental problem because we don't know if secondary buyers are purchasing ones that are securities or non-securities.
All right, let's switch gears here. Bail for former Celsius CEO Alex Mashinsky has been set at $40 million. That news came out this morning. He was arrested on fraud charges. Michael, what's your reaction to Mashinsky being arrested in this?
The allegations related to Celsius and the ongoing saga with Celsius, it's interesting in that many, if you talk to many investors in the crypto community, understood that this was potentially a Ponzi scheme or some type of fraud. He had very few major U.S. venture capital investors that you would see commonly investing in crypto projects such as A16Z or Paradigm or any of the household names. And so there was some red flags all along. But really, so many people lost money. I mean, I think there was over $1 billion that was not, accounted for when they filed for bankruptcy. And so it's not a surprising turn of events to see the arrest. It's a little late. We would have liked to see the SEC and CFTC and DOJ and others move before the bankruptcy even happened. But it's better late than never.
Alex, what's your reaction to this, to the timing? The company has gone through bankruptcy proceedings. To see this happen now, what's your take? What do you think's going on?
Could not agree more. Why did they wait so long? This would have been really nice before the bankruptcy. Who knows where the assets are now? And this complaint would have actually helped if the token holders wanted to file a direct or derivative action. Most of the assets already for Celsius have been distributed through the bankruptcy. So we're talking now about personal holdings of Mashinsky. I think, I agree with this concept that he just discussed about, there's a difference. Alex came from telecom. And it's very interesting if you move into this sort of finance, what he moved into was supposed to be banking. And originally that was actually banking. And so I think that's a very regulated area. And he had no experience. And so what I think is very interesting is that he was funded at all. And I think I'd want to talk a lot to the people who were funding him, but also where is the information about KeyFi and the people who are managing the money that I do not believe were actually registered money managers of any sort. So these were just some random people that were managing, hundreds of millions to billions of dollars.
Yeah, I think, Michael, to your point, the reason why those big funders weren't there with Mashinsky is they were busy giving money to FTX.
I was going to say, I think there's a lot of questions here for a lot of different people. All right, we're going to have to leave it there. Thank you both for joining us for this discussion this morning.
Thank you.
Thank you.
That was Michael Selig and Alex Damsker. We're going to take a quick break. Coming up, the CEO of Arkham joins us after facing criticism regarding the firm's crypto data marketplace right after this. Welcome back to First Mover. Crypto data firm Arkham Intelligence is facing scrutiny from privacy-focused crypto advocates after announcing a new service that incentivizes people to reveal the identities behind otherwise anonymous blockchain addresses. Joining us now to discuss is Arkham founder and CEO Miguel Morel. Welcome to the show, Miguel.
Hi, thank you so much for having me.
Thanks for being here. Now, it's been quite a week for you and Arkham. You know, some critics are calling the platform a dox to earn. I'll put that in quotations. How do you respond to this?
I think in general, many people are kind of, thinking about this new technology that we've developed, which allows people to make bounties and, make submissions of information regarding on-chain analysis. And I think rightfully, they're interested in knowing what are the boundaries, what are the guidelines of how exactly this marketplace is going to be used. One of the things that we've tried to be very clear about now, and recently we've issued guidelines is it is only for completely public information, and it should be used to give people market analysis, to give people alpha, and to help uncover scams, frauds, and rug pulls and exploits and things of this nature, not to necessarily invade any one individual's privacy, and certainly not to reveal private information.
Who's the user here? Who do you envision using the platform? Who do you envision participating in the ecosystem?
So we have had a beta program for the data analytics platform itself, which is a separate product from the Intel Exchange. And this beta has actually acquired hundreds of thousands of users. We released it in August of 2022. So we're coming up on the 1-year anniversary. And during that time, we've acquired hundreds of thousands of users, which are mostly made up of retail traders, professional trading and market making firms, journalism, and journalist websites and companies. And it's many people just trying to do on-chain analytics to try to understand more about what's going on in the crypto market, right? The fundamental financial assets of crypto exist on a publicly available blockchain. All of the information is given to everybody all over the world. Anybody can look at the network and observe what transactions are happening on Bitcoin, on Ethereum, and so forth. And so people use the Arkham platform in order to do this kind of research and analysis. And those are exactly the kind of people I expect to want to try to find additional info on the Intel Exchange.
So exactly how do we know, people are calling it snitch as a service, but how do we know if, the actual information, if let's say there's a whale wallet out there and they say that it belongs to me. Not that I'm a whale, but okay. Let's say there is somebody, you have a conspiracy, if you will. Several people say, this being the internet, let's have some fun and let's pin this whale wallet on this one guy. How do you verify whether or not that's truthful?
So like any blockchain analytics company or anyone who is providing data, you need to be able to verify the actual source of the information. For the Arkham Intel Exchange, whenever anyone makes a bounty or makes a submission of information, so the bounties are when people request information where they're trying to investigate what is going on chain. They say, I'm looking at this activity, it's suspicious, or I'm interested in learning more. Could somebody please, look into this for me? The submission is the reverse. Once somebody submits a bounty, anybody can look at that and then try and provide the answer. All of these things have to be reviewed and they have to be analyzed prior to actually going live. And if we cannot publicly verify that the information is, you can either replicate it or you can go and independently verify all of the information publicly yourself, then those submissions will not go live on the Arkham Intel Exchange. It's that simple. So somebody cannot just simply say, I think that this wallet belongs to CoinDesk, for example, right? If there's no evidence online that would suggest that's true, right? So it's a place to avoid misinformation. It's a place to avoid, hearsay, and we can only confirm it using publicly available information.
I do want to ask that because I guess the question everyone does have is, okay, what makes one bounty a yes, another a no? What the specific criteria is? Is there a process, a timeline, an amount of yes or no votes, et cetera, that happens at Arkham for something to get approved for a bounty?
So already we have a process in place that allows us to do blockchain analysis. If you go on the Arkham platform, you can see hundreds of millions of labels that are tagged by Arkham through two different processes. The first is algorithmic and focused on actually algorithmically identifying addresses and owners based on publicly available information, right? So this would include exchanges, market-making firms, large whales, project founders, things that are in the public interest for people to know what is going on behind the scenes. The same thing will occur on the Intel exchange, right? So if we cannot verify with existing data and with existing heuristics or analysis that all of the information being provided by the submitter is available on the internet and can be, independently audited and independently verified, then it will not go on the Intel exchange. And there needs to be some kind of argument for why you believe that this is the case.
I guess the question though is what's the actual? You say okay, it has to get approved, but like, who approves it? How is it approved? Is there, if let's say you get hundreds of millions of labels, how do we know who's who? I mean, like, how long does this process take? Are there people involved in it, or is it done algorithmically? What makes one approved? How can I get paid? I think that's really what it comes down to, because I have a whole list of people I want to snitch on and make money on.
So I wouldn't say it's necessarily for snitching. So in the guidelines that we just published, we said, you cannot use it for revenge posting or for harassment or, using private information. And so whatever is put on the Arkham Intel exchange would already have been on the internet and easily discoverable. I think that's kind of the whole point. But the way in which people can get paid is by doing the research online to try to find the publicly available attribution of who the particular owner of, that smart contract is, or who the person behind that exploit was. And once they can verify that, they make the submission. The submission is first checked algorithmically in accordance with the systems that we already have internally. And then second, will be reviewed by analysts in order to make a call and a judgment call decision about whether or not it's actually true.
How many analysts?
It depends on the submission.
Process?
Some of them are more complicated than others. The answer is it should take as long as it has to in order to make sure that the information is correct and it's safe to publish.
All right, Miguel, we know you have to go, but we just want to get one last question in here. The second part of some of the backlash that the platform has received this week has to do with referral links and an easy to decipher method for hiding email addresses, calling the platform's approach to user privacy into question. What's your response to that? Is this going to be changed in any way moving forward?
So user privacy is one of the most important things for Arkham. One of the things that I like to emphasize for people is that part of the referral program, one of the things that we implemented early on was the ability to see who actually referred you, so you could trust that you weren't being phished or it wasn't an incorrect link. Naturally, our platform grew exponentially since August. Like I said, we went from 0 to hundreds of thousands of people, and people started sharing the referral links beyond just their inner circle to actually sharing them publicly. And so, once we heard feedback from the community regarding, what they wanted out there versus what they didn't want out there, then now going forward, the referral links are encrypted and salted, and you wouldn't be able to see who the person referring you is. And so those changes have already been made. Like I've said before, no information that is put on the Arkham platform is ever sold for any reason to any third party. And so overall, that's not our business model, and ensuring the trust and safety of the Arkham platform will always be the number one priority for us.
All right, Miguel, we are going to leave it there. Thank you very much for joining the show.
Thank you so much.
That was Arkham founder and CEO Miguel Morel. We're going to take a quick break. When we come back, we'll dig deeper into XRP's massive rally right after this.
All right, welcome back, everyone. Bitcoin is above 31,000. That's not a joke. And XRP is ripping, or should I say rippling, on the news that of a judge ruling that the sale of Ripple, the company's magically discovered XRP tokens, which God knows how they got it, on exchanges and through algorithms did not violate federal security laws. But institution's different story. Anyway, never mind that. Joining us now to discuss is CoinRoutes CEO and co-founder Dave Weisberger. Welcome, Dave.
Thanks for having me.
Glad to see you. So XRP, as you see, shooting up, taking along with it Stellar. People forget about Stellar. I haven't. Stellar is also going in sympathy with it. What does it mean for the overall crypto market and for all coins, not just Stellar, which, by the way, according to my little research at the Tide, which I'm going to give a plug here because I did some little thing here, 0.81 correlation coefficient, Stellar and XRP. But you have a lot of altcoins that also go along with it. What's that?
I mean, they have similar roots, right? The same people.
Similar guys.
Yeah. So, I mean, look, first of all, I
Don't
have
tell
to
them
tell
that
I was shaking my head when Alex earlier was talking about the case. I mean, I find it amazing how lawyers always focus on legal minutia and not understanding the bigger picture of what the judge was saying, because Judge Torres actually did a ridiculously good job in cutting through the nonsense. So let's be clear. What did the ruling say? And this is why the market is reacting the way the market did. The ruling said that when Ripple executives sold XRP to fund their operations directly by contracting with individual investors, institutional individual investors, but, meaning single ones, contracting with them, that constituted a security sale, and that was problematic. What she also said was, however, that once those tokens were out in the wild and are trading on exchanges, that people are buying or selling XRP. XRP is a utility token. It is not directly funding Ripple, and therefore that was not a security. Now, this is an incredibly important distinction because of its far-reaching implications for cases against Coinbase and other exchanges and secondary market trading. And so that distinction makes sense. Now, her claim that this will make it go for appeal, I've seen plenty of lawyers saying that it's going to be very difficult to appeal on those grounds. In point of fact, it'll probably be as good an appeal as the Biden administration appealing the judge's ruling that stopped airplanes, having to be wearing masks on airplanes. It will be politically
Ouch.
Very unpopular as well. It's literally that simple. I mean, the SEC has been overstepping. And if you read, and I urge everyone to read Coinbase's actual legal response, which reads more like a novel than a legal pleading, to why they're requesting summary judgment of dismissal. And these two cases are extremely related in that regard, because there's also a footnote in the XRP which basically says for securities trading on exchanges, the fair notice defense is absolutely alive and well. It simply doesn't apply to where Ripple knowingly sold to fund their operations in the beginning. And that's an important distinction. So why did the market react the way it did? Well, XRP token holders in the United States, a lot of people who might have wanted to buy XRP for whatever reason, I'm not going to talk about the investment merits of the token or not, but those people had very few places to buy it. And in fact, very difficult expectations of selling it because it wasn't listed in any of the exchanges. I mean, I guess Uphold was selling it, and their site crashed yesterday because there was so much demand when it first came out. But the truth of the matter is, people buy things with the expectation that they can get liquidity when they do want to sell, whether they are speculating in the short run, buying it for long-term appreciation, buying it because they see the use case exploding and they think there'll be demand. It doesn't matter the why. The why is irrelevant. What matters is people care about liquidity. So Ripple popped, basically doubled almost, and now it's settled back in a little bit. XRP, you're right. Sorry, XRP. You would think,
you don't want those angry YouTube commenters.
Yeah,
you're going to get a whole bunch of angry comments on YouTube by people with several numbers after their names, and then they go crazy.
You're right. So the XRP token is clear, but the impact, it goes well beyond that. So we saw Solana and pretty much all of the coins the SEC named in their rushed out cases against Binance and Coinbase. And I say that because they had two different lists. They didn't even compare or take the time to reconcile them. But all of those coins that the SEC claimed are securities are pretty much not securities today. And that is a very big.
Well, it's not entirely cleared yet, right? Because we still have to go through the process of dealing with the Coinbase case before we can definitively say those aren't going to be deemed as securities by the courts. Because while this particular case had to do with XRP, it didn't say anything about Solana and Polygon, et cetera.
Well,
and that's going to be it might give us a clue.
But it's one federal. I want to be clear about one point. My friend John Deaton likes to make this point, and so I'll give him credit for it. Howie was talking about Orange Grove sales in a particular way, but under no circumstances does the Howie case ever declare oranges securities. Think about that. Because what effectively Judge Torres was saying is these tokens, once listed and out in the wild, unless they don't represent a claim on corporate ownership like an equity, a claim on corporate repayment like a bond, they aren't basically raising money for the companies themselves. And in fact, in many of these cases, there are no companies. There's foundations or distributed networks. That's the key. And so I think that people will assume that the trading of crypto until there's congressional action is in a legal kind of nowhere land. And that's difficult. And I believe this will give an impetus for Congress to actually have real serious discussions. And right on the heels of this, we have Loomis Gillibrand with their bill, and a couple weeks ago, McHenry with the Agriculture Committee in Congress and the Finance Committee working together with their bill. I think that you have enough people looking at this that people think we might start making a move towards regulatory clarity. But in the nonce, I think the market has basically said, listen, we don't think any more of these coins is going to get delisted except for tokens that really don't make any sense whatsoever, right? And if you can say the Cell token is a perfect example with Mashinsky of it went to fund the enterprise, right? And so, that might be different. And I think that is a very important distinction people need to understand.
What do you make of the
I must have a vitamin
token?
C deficiency.
What do you make of the Cell token pumping on Mashinsky's arrest news? I believe it's up about 20% right now.
I don't. I don't understand it, honestly. I think that it's very hard for me to come to grips with somewhere around 95+% of all crypto tokens, why they exist. Layer ones, I understand. I don't understand single-use tokens for individual enterprises unless they're limited to, effectively, like if Amazon decided to take their Prime memberships and make tokens out of it so you can fix the price, it basically brings revenues, to the current from the future. Yeah, you could do that. I don't understand where there's enterprise value in the Cell token. I haven't looked into it. You should probably ask someone like Simon Dixon, who has been hip deep in this from the beginning, to give you a good commentary on that. What I can say is whenever in finance you see the perp walk, whether it's Bernie Madoff or Jeffrey Skilling from Enron or any of the other people, anytime someone is walked out that people are mad at, markets tend to rally. Why the Cell token would rally along with it, I couldn't describe, but I'm not an expert on the potential use cases of the Cell token in a post-bankruptcy Celsius, which is mostly a mining company. So it's hard for me to tell what the tokenomics are for that.
Craving oranges now, by the way. Thanks.
Yeah, sorry about that. But the point that I was trying to make about liquidity is there was a significant concern when the Coinbase case was was first brought, that all the tokens that were named, people sold them, and they went down on average 30-some-odd% on that day. And the reason was people thought, oh my God, it might get delisted. I might not be able to sell these in the United States. And that is a serious concern. So with that alleviated, people are calling for alt season and, Lambos and when to the moon. I don't believe that that's what's going to happen. What I do think is going to happen, however, are people who are interested in these tokens can buy them with a little bit more security that they can sell them. And so, you see the initial pop like you always do, and then you see it retrace a little bit. And now the question is, what's the value? And now I think that Bitcoin will go back to a leadership role in the market again. Given what's happening with the Bitcoin ETF and what's going on in Congress. And I think Ethereum is right alongside Bitcoin in a leadership role in the economy of crypto. And Vitalik even commented about this, back, he thought it was ridiculous that, people would sell based on lack of liquidity of competing tokens.
All right, Dave, we are going to have to leave it there for today. Thanks so much for joining the show.
Thank you.
That was CoinRoutes CEO and co-founder Dave Weisberger. That's it for First Mover. I'm Jen Sanasi. Thank you to my co-host, Lawrence Lewitton. Lawrence, I want you to know that I am always laughing internally at your jokes if you don't hear it externally.
Well, thank you.
I love them, and I'm so happy you bring them.
I'm just glad you didn't blush when he was talking about Lambos. I know you have one, so.
Well, I didn't want to brag, I didn't want to brag.
I know, humble. I know, it's fun. Enjoy it. Driving around Toronto, whatever it is you're at.
There you go. That's it for First Mover. We will see you on Tuesday. CoinDesk TV is dark on Monday. We'll see you on Tuesday. You're watching CoinDesk TV.